Good morning. Oh, you can do better than that. Good morning. All right. I want to welcome everyone to VICA's 26th Annual Business Forecast Conference. My name is Darrell Brown, and I'm the Senior Vice President for U.S. Bank. We are proud supporters of VICA and one of the Business Forecast Conference's breakfast sponsors, along with Cal State University Northridge. Let's all thank our presenting sponsor, Wells Fargo. And I want you to know it's not uncommon that Marlon and I tag team. We go back 20 years, and when it comes to the community, we are so connected, and I couldn't be more proud to be alongside my dear friend, Miss Marla. I know there's another name, Clement. We go back that far. A new mom, I might add. For more than 65 years, the Valley Industry Commerce Association has been a leading advocate for the San Fernando Valley business community, tirelessly advocating for the region's job creators. Since 1988, VICA has brought together the area's business leaders, academics, elected officials, and other key stakeholders to discuss solutions for a better business climate at our conference, this conference. Californians are right to be cautiously optimistic in the face of a slowly improving economy after years of recession and a shaky recovery. Where do we go from here? That is the question. This event is one of the premier events in all of Southern California by bringing together knowledgeable economists, including U.S. Bank's own Jeffrey Kravetz, my dear friend. Business leaders are given information that would help prepare them for what the future holds. The biographies of our moderator and panelists are included in your event journal. So let me briefly introduce our moderator for today's breakfast panel. She is Wells Fargo's regional president, and I go back, as I said, gosh, Marla, 20, 25 years, as well as a VICA board member. I love this woman, I mean that. Please welcome me in joining and welcoming my friend, great community leader, Marla Clement. Thank you, Marla.
Thank you so much, Darrell, for that warm welcome. Darrell's been a great mentor to me, and he's struggling with my name because I got married, I had a baby. He's like, what's going on? So I have a 3-month-old at home, so I'm so excited to be back at work. I love seeing all of you. And I'm so excited to be asked, what an honor to moderate this panel. I've been a proud VICA board member for several years, and one of my most favorite events that they do is the opportunity to hear from our economists. So I hope you enjoyed as much as I have in the past. Can I have a show of hands? How many of you is this your first time? Oh, that's fantastic. How about your second time? More than 3? Well, thank you for your continued support of VICA, and thank you for being here this morning. We're very excited to have this panel of experts with us. So let's get down to business. As you know, our panelists have prepared some important information for us, so let me introduce our speakers and then we'll get started. First, we have Gary Schlossberg, Vice President and Senior Economist, Wells Capital Management. He will be giving us an overview of where the economy is going on a national level. Then we have Jeff Kravetz next to him, our Regional Investment Director for the Private Client Reserve of U.S. Bank. He will be giving us an overview of where the economy is going on a state level. And then following Jeff is Bill Roberts, our Director of the San Fernando Valley Economic Research Center and Professor of Economics at California State University, Northridge, with the local forecast. So without further ado, I know you're excited as I am to hear from all of them this morning. We are going to be starting with Gary on the national level. Thank you so much to all three of you for being here this morning. Let's give them a big round of applause to get us started.
Thank you, Marla. Pleasure to be back here. It doesn't seem like, I think it was a year ago that I last spoke to the group, and in that time the economy has continued to struggle, but I'll try to stick to the highlights. We're trying to keep our talks fairly tight, and I do tend to get paid by the word, so this is going to be an effort for me. But I think the first point I would make about the economy itself is, at the moment at least, I think we're best positioned for the kind of satisfactory, self-sustaining growth that we've been looking for the last 5 years or so. Really, the support is coming at 3 levels. The recent economic data showing economic activity running at a reasonably good rate following a very strong second quarter. A lot of that was weather-related. The economic data of late have been not quite as strong as what we saw in the spring. There was some concern that this could mark yet another turn towards sluggish economic growth, a pattern that we've seen over the past 5 years. This growth recovery not only has been disappointing following a very deep recession, but it has been very stop-go, and the concern is that the loss of momentum that we've seen in some of the numbers over the last couple of weeks may signal yet another growth pause. Our sense is that what we were looking at was really more a shift to more sustainable growth. The data coming out today, the employment report, I think reinforced that view. Jobs were up more than expected, close to 250,000. Earlier months were revised up. The unemployment rate dropped 0.2% to 5.9% nationwide. Some of that was due to a drop in the labor force, which is not a good thing, but some of it was due to strength in that household-based employment. Beyond that, though, we see support that really we hadn't been seeing for the last 5 years, which really is raising hopes that this growth that we are looking at, while not spectacular, will be more satisfactory and less bumpy than what we've seen over the past couple of years. For starters, the drivers of economic growth. If you look at the kinds of things that sustain spending, many of those drivers are providing tailwinds for the economy. We're in the 5th year of economic growth, actually more than 5 years. At this mature stage in the economic cycle, typically we see a rotation of strength from consumers to business, and we're really counting on businesses to carry more of the weight in sustaining economic growth and the drivers behind investment spending. In fact, investment spending itself has shown signs of holding up quite well. Equipment orders at a double-digit rate over the last 3 or 4 months. Behind that, operating rates are approaching that 80% threshold, rule of thumb threshold, for expansion and capacity. Secondly, the age of the capital stock. Because of all the deferred spending over the past 5 years, given all the uncertainties over the economic outlook, the policy environment, and the like, the age of the U.S. capital stock now is higher than at any time since 1958. So there is some deferred spending that has to be made up as well. Cash flow remains good, and the willingness to spend cash is greater now than what we've seen in the past couple of years. Energy prices are moving lower. That's like a tax cut, freeing up income made available for other goods and services spending. And in fact, if you look at inflation-adjusted incomes or purchasing power, they are growing at an above-average rate. Household wealth, because of the rally in the stock market and because of the rise in home prices, at least until recently, growing in the upper single digits in an inflation-adjusted basis, lifting household sentiment, consumer confidence, borrowing capacity, and hopefully spending, particularly for the upper-income families, quite frankly, but they do provide a support to consumer spending and the overall economy. Less fiscal drag. We're not seeing the kind of tax increases that posed a threat to the growth recovery about a year ago. Spending cuts are not the issue that they were a year ago either. The deficit is coming down, but it's because of the strength in the economy, the impact of past tax increases, reducing transfer payments, and at the same time boosting tax revenues. The news isn't all good. The housing recovery still remains pretty lackluster. Upside down, more of the strength in multifamily or apartment activity, reflecting the bias toward renting rather than home ownership. Behind that, two of the weak fundamentals, despite the fact that housing affordability still remains quite high because of those low mortgage rates. One, household formations, the underlying demand driving housing demand, remains quite weak. Over the past 12 months, nationwide household formations are up only about 450,000 against a long-term norm of 1.2 million. The deep recession, some demographic changes are having an effect on underlying demand as measured by household formations. And secondly, credit availability isn't what it is in other areas of the economy. The policy changes, the putbacks of mortgage-backed securities to banks, the uncertainties raised about the legal liability, the regulatory environment, lingering economic uncertainties, whatever it is, there's still, relative to other loan categories, a greater reluctance to lend and a greater reluctance to borrow. That's easing up a bit, but still a restraint on the housing recovery. The other tier that's supporting economic growth, which has been improving gradually over the, as the recovery has proceeded, are the after effects of the meltdown in the financial markets. These acted as a real restraint. I think we're as responsible as anything else for the weak economic growth. And we've seen the adjustment to that meltdown, to the aftershocks of the meltdown, largely completed, we think. For one thing, the deleveraging, particularly by banks and households, is largely completed. Debt burdens of households, measured by debt payments as a share of income, down to their lowest level in at least the last 30 years. And we're beginning to see that reflected in loan activity, borrowing. It's extending beyond auto loans now to credit card receivables, which are essential to financing, to providing the lubrication to consumer spending. Banks have rebuilt their capital, are in a better position to lend, certainly been in a better position to lend than the European banks, which have been slower to adjust. And as I said, that lending recovery is broadening and strengthening. Lending is the lubrication for economic growth. It's really the lifeblood. And that lending growth, now at a 5-year high, is broader than what we've seen in the last 5 years. And finally, there's a greater willingness among both businesses and households to spend that pile of cash that's been sitting on the sidelines for so long. Those cash balances are still high, but as I said, businesses are beginning to deploy that cash in equipment spending, merger and acquisition activity, and households are reducing that spending, those cash balances as well, helping to support a moderate growth in spending. The bottom line, we think the economy is capable of growth of about 2.5% to 3% over the next 12 to 18 months. It's not spectacular, but it is strong enough, we think, especially if it's at the upper end of that range, to continue to make inroads against the unemployment rate, providing an underpinning to the labor market. The downside to that is that this era of historically low interest rates, we think, is slowly transitioning. The operative word is slowly. We don't look for interest rates to rise straight away, but we think the economy is positioning for a first interest rate hike by the Federal Reserve sometime in the middle of 2015. The rise in interest rates, we think, will be a little bit different this time than we've seen in the past. Normally, at this stage in the economic cycle, you'd expect to see long-term interest rates rising more noticeably than they have earlier in the cycle, partly because inflation remains subdued, and we think it will remain subdued for now, partly because of the influx of money coming in from abroad, flight capital, given all the geopolitical uncertainties out there, and yield-oriented, yield-driven investments, moving away from low yields in Europe and Japan. That money, that demand, is driving up the price of securities and driving down yields. As we move ahead, we think that the rise in rates will be led by, as in the past, by intermediate rates in the 1 to 5 year area. We're already seeing that policy-sensitive 2-year yield moving up. And that's more like the canary in the coal mine. It's an indication that investors see that first interest rate hike at the end of the tunnel. Given the strength in the economy, or moderate economic growth, given the absence of inflation pressures, the fact that wages still remain subdued, and they were in September based on the latest jobs report, we think the rate hike itself will come later rather than sooner, sometime around the middle of the year. As I said, the June policy meeting is one where there is a press conference, and that seems to be the most likely period, but clearly the timing will depend on how well the economy performs between now and the middle of next year. The move higher in long-term rates, while it will be subdued, we think that rise could be bumpy. For one thing, rates remain artificially low. And as the economy improves, those low rates could begin to normalize a bit, move back up to a level more in line with the economic fundamentals, growth and inflation. And secondly, the economy is seeing the asset markets, financial markets, distorted by this prolonged period of very aggressive accommodation. Our biggest concern about the economy, the biggest threat, we think, is less inflation and interest rates and more the kind of distortions, unraveling the bust in asset values, the unraveling of some of these leverage portfolios, opaque investments that created such a problem 5 years ago. We don't think we're there yet. We think the risk of that is fairly low, but we are moving in that direction. Many of the same imbalances that developed between 2004 and 2008, we see developing this time around. And as the Federal Reserve moves toward tightening policy, and even that could be more difficult given that the financial markets are awash in cash, but when that increase comes, it's still unclear how the financial markets will respond. So we still could see some volatility out there. Looking further out, we see a couple of restraints on economic growth. I wouldn't go so far as to say it's a new normal, but over the next couple of years, several headwinds moving further out. For one thing, the demographics are moving against the economy. We're in an aging population. They're not as bad as they are in Europe and Japan, but certainly slower population growth, slower labor force growth will restrain the economy's growth potential. Secondly, we do have lingering fallout from the financial meltdown, a much tougher regulatory environment for banks. We could see the shadow banking or non-traditional banking system come under greater regulation as well. A reluctance to ramp up borrowing among households the way they did over the past several decades leading up to the meltdown in 2008, 2009 could act as a restraint. Policy uncertainties. The pendulum has been swinging to such an extent over the past several years, not only in the tax area, uncertainties about the possibility of wealth taxes increasing, the possibility of a more progressive tax system, regulatory hurdles, fees and the like to finance a budget deficit, which could very well begin to grow even if the economy is holding up well as entitlements continue to accelerate, could begin to grow as early as 2017, 2018. All this creates a lot of issues for businesses, the kind of issues that I'm sure many of you are confronted with the new minimum wage proposal and the like. Broadening out beyond that, that could create a headwind for economic growth. More fundamentally, we're in a much more competitive global environment. Pricing power for businesses across the country is a good deal weaker. There are exceptions, of course, but generally speaking, the ability to push through higher selling prices to either expand margins or in response to higher costs has been more difficult over the past decade, frankly, over the past several decades. And businesses have had to respond to that, especially when unit sales are growing at a modest rate, by focusing more on cost cutting. Inevitably, that affects labor, the willingness to hire, the ability to grant wage increases, the raw material for income growth driving consumer spending. And we think that will remain an issue going forward. There is the issue of the jobs mismatch. Skilled professions, a real demand there. Baby boomers retiring from skilled manufacturing, transportation, truck drivers and the like. All this creating a very tight market at a time when the pool of labor unemployed labor is still quite high. One indication is in this chart. My apologies. I tell people I'd love to fire my research assistant. The problem is, you guessed it, my research assistant is me. But what this chart shows you is year-over-year increases in job openings, the blue line. Hiring is the red line, year-over-year increases there. And you can see throughout much of this recovery, job openings have been rising more rapidly. In fact, lately they've been diverging significantly with the growth in hiring. The point is that the market may be a bit tighter than it appears. Businesses are having trouble finding the right workers for the right positions. And in fact, this is showing up in small business surveys as well. The percent of small businesses reporting difficulty in filling at least one position at a historically high level. An indication that this mismatch could restrain the growth in employment and the growth in the economy as well down the road. And finally, again, the risk of more volatile asset markets, the boom and bust in asset values that we've seen over the past couple of decades, beginning with the stock market rise and fall in the late 1990s, has an unsettling effect on the financial markets, and as we've seen, can easily spill over to the economy as well. In closing, just a couple of positives, though. I think over the longer term, the U.S. Continues to benefit from a number of strengths which, out beyond the next couple of years, I think will serve us well. We do expect to be on the leading edge of growth among the developed economies. Even within the aging population, opportunities, spending patterns changing, healthcare, travel, financial services, and a retiring population continuing to grow. Younger people coming into the workforce, the demand for big-ticket goods, housing, we think will benefit from that as well. The need for infrastructure improvements and the opportunities there, both here and overseas. Our ability to innovate, our entrepreneurial class, the importance there, particularly important here in Southern California, but we're seeing evidence of that throughout the country, leaving us well positioned, we think, to compete in what we think will continue to be a highly competitive global economy, a global economy where living standards are improving, the opportunities to serve a growing middle class overseas and here as well, we think will continue to underpin economic growth in the U.S. And as we get by this very difficult period, we hope to see growth returning to a more normal, more satisfactory level. Those are my remarks. I'll turn it back over to Marla. Thank you.
Thank you so much, Gary, for your insights on the national level. We will have an opportunity to have questions at the end of these three great speakers we have here today. So we're going to move over to our state level and hear from Jeff. So please welcome Jeff.
Thanks, Marla. It's great to be here in Burbank, home of the motion picture and television industry. So my talk is entitled California Economic Outlook. It's a wonderful state, and it pays homage to one of my favorite movies, It's a Wonderful Life, starring Jimmy Stewart. So indeed, California is a wonderful state. So what I'm going to do in the presentation is let you know where we are and where we're headed in the Golden State. Okay, so California is a colossus among U.S. states. If California were its own country, it would be ranked the 8th largest economy in the world, behind Brazil and above the Russian Federation. So California is huge, a $2.2 trillion economy, very diversified. We've got manufacturing, information technology, tourism, agriculture, and of course, real estate. So California is enormous. You've got 58 counties, 481 incorporated cities. And California is home to some of the most famous valleys in the world, the San Fernando Valley, the San Joaquin Valley, and of course, Silicon Valley. So California is recovering and growing. You know, the economy is really on the mend since the Great Recession and showing good forward momentum. What's really significant is the California budget deficit, which was $25 billion, has basically been erased. And now the state is looking at budget surpluses. So the rating agencies have taken notice, and Moody's Investor Services has upgraded California debt in June to AA3. And that's the highest debt rating since 2001. And the reason that's important is because if you have a higher debt rating, that means that your borrowing cost is going to be lower. Next, jobs. It really is all about jobs, and a lot of the slides I'm going to present today are about employment. So jobs are returning to California. During the Great Recession, California lost about 1.3 million jobs. Now, those jobs have essentially been regained, and we're making very strong progress there. The unemployment rate in California, a little higher than the national average. It's gone down from 8.9% in 2013 to 7.4% today. So above the national average, which has dropped this morning to 5.9%. So we do have some work to do in the area of unemployment. So what I'm going to do is take you through some regional highlights for the state, because the state is so big, it's really 3 economies. So let's start in the north. Northern California is on fire. Not literally, but when I say that, I'm talking about technology, right? It's all about technology. Information technology has been making a resurgence in California, and it's been really good for job growth. So in Silicon Valley, in the Bay Area, job growth overall has been averaging about 3%. Now let's take a look at the Central California and Inland Empire. So these 2 regions of California suffered more during the financial crisis, mainly because they had a really bad real estate downturn. But the good news is if you look at the Inland Empire, it's really making a strong recovery, mainly due to real estate. Now, the Central Valley is home to the nation's largest fruits and vegetable producers. It's doing well, but it's really at risk because of the drought, and I'm going to talk a little bit more about that later. So let's go to Southern California, where we are. San Diego's been a very strong job grower at 2.7%. And then we've got Los Angeles and Orange County, which have also been good, but not as strong. We've got Los Angeles at 1.6 and Orange County at 1.2%. So let's take a look at real GDP. What that is GDP minus inflation. So if you take a look at GDP versus in California versus the rest of the nation, what you'll notice is when the economy is good, before the Great Recession, California was above the national average. So when we fell into the recession, California was below the national average, and now we're starting to catch up, and we're getting close to the U.S. average. And what's important about this chart is that if you look at where we are now, we've actually, in the U.S. and California, we've eclipsed that high, that pre-recession high. So we forecast 2014 and 2015 to be a very strong year for California with regard to GDP. Okay, now we're going to look at GDP per industry. And what this chart is showing is the different sectors of the economy. So it's the U.S. versus California. And there's some important trends I want to point out on this graph. So the biggest is California real estate has a really outsized footprint compared to the national economy. Other areas which we have a bigger footprint is information technology and professional and technical services. Here we've got a chart of employment, and this goes back to 1990, the US versus California. And what's notable here is that California employment, it's always more volatile than the rest of the US. And you can see when the business cycle is good, California outperforms. And when the business cycle is not good, we underperform. Now the good news is since that bottom in 2009, we've rebounded sharply, and we're actually above the national average on employment, but we're starting to moderate. So employment growth, this is broken down by sector also. It's a forecast for 2014. And if you look at the top, what's leading the hit parade in California? It's leisure and hospitality. Not far behind are health services and retail trade. But if you look at the bottom of the chart, education, government, and finance and insurance are actually forecast to be negative for this year. Now, let's look at metropolitan job growth. So this is showing year-over-year metropolitan job growth to July 2014. So again, San Francisco at the top of the charts at 3.4%. But look, Riverside, San Bernardino, the Inland Empire, making a strong comeback at 3%. Then if you drop down to Los Angeles, 1.6%, and then Orange County at 1.2%. You know, Orange County, even though the number's weak here, Orange County has one of the lowest unemployment rates in California. It's 5.4%, better than the national average. All right, lights, camera, action. Los Angeles is back. So what this chart is showing, it's going back to 2001, and it's showing job growth. And you can see Los Angeles, Long Beach, and Glendale at the bottom of the chart. So we are recovering here, but less than the California average. And what's notable is that if you look at the port of Long Beach, it's one of the busiest seaports in the world. And it's a key link for trade between the United States and Asia. That port has 22 shipping terminals. And containers go through that port, everything from cars to commodities to consumer goods. And that port handles almost $200 billion of cargo every year. All right, California housing. It's definitely a brighter picture. So we've got two charts here. The one on the left is sales of existing homes. And you can see that 2014 is going to be a weaker year than 2013, but we are forecasted to rebound in 2015. Now, the chart on the right, that's the median home price. And everyone knows it's very expensive to live in California. So I came across this statistic, which I couldn't believe. From the late 1990s to 2006, the average home price in California was 75% above the national average. So yeah, that tells you how expensive it is to live here. So housing prices fell pretty dramatically after the peak and are starting to recover. And last year was a very good year for housing prices in California, mainly due to a lot of cash buyers and investors. So we forecast home prices to be strong, but to moderate and really to come back to more normal levels. Welcome to the Hotel California. This chart is Los Angeles County employment visitor count and spending. And what you can see is it's been very strong. So tourism is a huge industry in California. So if you look at that chart, the purple bars, you've got domestic and international visitors in billions. And there was a blip there in 2009, and we've rebounded to those pre-recession levels. Now, that orange line is actual dollar spending, and we're up to $17 billion. So California has great places to visit. The top 5 places to visit in California are focused on our natural resources. So number 1 is Yosemite. Number 2, Disneyland. Number 3 is Death Valley. Number 4 is Big Sur. And rounding out the top 5 is Lake Tahoe. This shows personal income and sales growth, and it is improving. So those green bars, that's personal income. Pretty steady growth going back to 2004. We do have a blip during the financial crisis, but very strong growth there. And then if you look at taxable sales growth, that's the blue line in the middle of the chart, or in the chart that looks like it has a big pothole. So it fell off dramatically during the financial crisis and has really rebounded very strongly and is starting to moderate. Now, one thing which is very important to note about California is Californians are burdened by high energy costs, and it really shows up in gasoline. So gasoline is really the most expensive in California, except for Hawaii, and California is taxed very highly on gas. It's about 52 cents a gallon. And the other thing that makes California gas expensive is California has some major refineries, and they tend to run at full capacity. So if there's ever an issue with one of those refineries, it can spike prices of gasoline. The other thing is reformulated gas in California has a higher standard than the national average. Okay, California, it's an expensive place to live. It's not only transportation costs, but housing is really off the charts in California. So take a look at this map. The map is showing you how much households spend on housing. So that the darker the state, the more they spend. So if you live in the upper Midwest, it's not expensive to live. The most expensive places to live in the United States are California, Hawaii, New Jersey, and Long Island. And in California, working households spend on average over 50% of their income on housing. This is really a tough problem. We were talking about this before in San Francisco, where a lot of those tech firms have moved into the city and displaced apartment dwellers. So the cost there is extremely high for housing. Okay, we've got to talk about the drought. So California is in the third year of the worst drought in 100 years. Okay, California has the largest agriculture economy in the United States, $45 billion. And I tell my wife, I love California avocados. So we've got to get this right. 80% of California is in a severe drought, and it's really affecting farmers and ranchers by driving up the cost of water. But it's also going to have an impact on revenue. We could lose about $5 billion in farm-related revenue this year because of the drought. It's also impacting the California lifestyle. And if you look in many cities in Southern California, there's starting to be water restrictions. And if it gets worse, it could impact the growth rate for California. So I think this is a great opportunity for government and business to work together to try to find the most efficient ways to use California's natural resources, their water resources. All right, I'm going to wrap it up here. So in conclusion, despite the fact that California is an extremely expensive place to live, there's a lot of traffic, California is chugging along. It's really full steam ahead. The California economy, fortunately, is very big and it's growing. And the thing that the state really has going for it, it's got a diverse economy, which is starting to fire on all cylinders. So information technology, professional and technical services, and real estate are leading the pack. And here's the big one. Jobs are returning to California. It's really all about employment and jobs. So hiring's been slightly better than the national average. It's starting to moderate. California job economy appears to have very good forward momentum, and hospitality and leisure are definitely leading the way. So my last point here is real estate. And remember that chart in the middle, how important California real estate is to the economy? California real estate is really back. And those recent surges that we've seen in metropolitan home prices, we believe that those are going to start to moderate to a more normal level. So to wrap it up, the future of California is bright. It's a wonderful state with a wonderful future. Thank you.
Okay, let's give Jeff another big round of applause. Just purchasing a home, I understand what you're talking about, housing costs, very expensive in California. Now I'd like to welcome my friend, and I've heard him speak many times and learned a lot, our very own Bill, our local perspective. Thank you, Bill, for being here again.
Good morning. As Marla said, I'm Bill Roberts. I'm director of the San Fernando Valley Economic Research Center. We've been in business for about 20 years now. The research center is located in the David Nazarian College of Business at California State University, Northridge. And what I'd like to do is to at least give you an outline, so you don't get lost. I mean, you're sitting out here eating, so you don't get lost and you know where I am. Here's an outline of what I'm going to talk about. I'm going to talk about the local economy's current state. Then I'm going to move on and look at kind of what's happening to employment in the Valley. There's been a number of changes that are taking place since the Great Recession, so I'm going to talk about those. Then I'm going to do something novel for a breakfast forecast session and actually give you a local forecast, which is something we typically don't do. Now, in terms of getting this local forecast, part of my job is to complain about there's no data. It's real hard to forecast anything when you don't have any numbers. And the real problem with the San Fernando Valley from an economist's perspective is there's no numbers. We aren't a political entity, so the U.S. Bureau of Census doesn't give us census data for the Valley, except with a 2-year lag and then for a 5-year average. So come back 2 years from now and I'll tell you kind of how we look today, more or less. But it'll be how we look today adjusted for 5 years or 4 years of prior data. And even if you look at unemployment data, we don't get unemployment data for the Valley. The best we get is the Bureau of Census numbers for the greater Los Angeles, Long Beach area. And then we can kind of extrapolate from that, but there's no good way of extrapolating. The best widespread, readily available data we have is housing. So if you've been here for the last 4 or 5 years, I talk about housing. You know, it's the old adage, if the only tool you have is a hammer, every problem looks like a nail. Well, if the only data you've got is housing, every problem looks residential. So I'm going to talk about the housing market. And in terms of the housing market, as my predecessors have said, there's sluggish sales. You know, and the Valley is not unlike any other area in California. Sales are real slow, and they've been slow for a long time. They started to recover a bit after the Great Recession, but this year's been, I mean, if I were a realtor, I would say dismal, and that's probably an underestimate. But the one good thing about housing prices is they're steadily rising. So even though we aren't selling the homes, they're going up at a gradual rate, kind of what you would expect as a normal rate of growth of housing. And I think the best news in the housing market is, for the Valley at least, foreclosures have almost disappeared. I mean, we were running during the Great Recession 400, 500 foreclosures a month. The month of August, we had 24. I haven't seen 24 foreclosures in a month since 2006. So there's kind of good news in the housing market, at least on the foreclosure side. But that's also taken out the investors that were coming in buying up the foreclosed houses. So we're back to kind of a more normal time in housing, except if you talk to the realtors, there's nothing for sale. And it's real hard to have a housing sale if nobody's selling. Now, it wouldn't be an economic forecast, and I wouldn't be a good economist if I didn't have a graph. So you can look at the graph and go, oh my God, what's this mean? This is a graph of housing sales, and you'll notice there's spikes in here. This goes from 2012 to current. And the higher spikes are the summer months. Summer months, we typically, in June and July, people move. So we have a rise in June and July, we have a rise in June and July in 2013, and we kind of have a rise in June and July in 2014. But if you look at the last little bump over there, that's 2014, and that's really kind of dismal. If you look at Valley housing sales, say in 98 and 99, which were kind of normal years, it was before the subprime lending really kicked in, it was before the housing bubble started to kick in, we'd have 2,000 to 2,100 sales a month. Now, housing stock hasn't changed that much. We're having, in the boom period of the summer, 1,400 sales. We're running about 2/3 of what I would consider to be a normal level of sales. So sales are sluggish. And we're going to go into kind of the selling downturn. You know, people don't really like to move around the holiday season. So you've got the lower levels there. Those are the holiday season. So sales are going to be dismal because it's the holiday season. And I expect these sluggish sales to stay in California, in the San Fernando Valley, probably through most of next year. You know, what we're really going to need is population growth. So we've got new buyers coming in to buy up the entry-level housing. And entry-level housing in the Valley is about $300,000 minimum for a median price. So, you know, they buy up to $300,000 homes. Those people then, when they sell, will go and buy the $400,000 to $500,000 home, and it kind of boosts the market. We aren't seeing that kind of push from the bottom. In terms of housing prices, you know, we have, you know, they're growing up. We had a kind of leveling of housing prices towards the end of last year, kind of stabilized. This is the median housing price for a Valley home, and we're right now at a median price of about $560,000. At the peak of the market in 2006, the median home price in the Valley was $660,000. So we aren't there yet. It's probably 3 to 4 years, maybe a little longer, before we get back to what the price was at its prior peak. But they're doing what you would expect normally housing prices to do. They've been going up in the Valley year over year since about the start of this year at 4 to 6% per year. And given kind of rates of growth, rates of population growth, inflation rates, that's kind of about where we would expect them to be. So it's normal in terms of prices. It's real sluggish in terms of sales. Now I'm going to slip into an area that makes me, in some sense, real uncomfortable. I'm conflicted in doing this. When we have no data. So I'm going to talk about the Valley economy in the absence of data. Well, yeah, we have data. We've got the 5-year American Community Survey from 2012. It's the latest data we've got. So it's 5 years, and to compare that, I can go back to 2009, but that's a 5-year data period as well. So the statistician in me is just getting really uncomfortable now. And I'm talking about numbers that you really can't compare, but the economist in me says, if you got the numbers, use them. These are the numbers we've got, I'm going to use them. Now, in terms of the survey, the problem here is there's a 2-year overlap. So if you're looking at a data series that goes 1 through 8 for the 9 years that are there, the first 5 and the last 5 have an overlap of 4 and 5. So I'm including 4 and 5 in the middle there. So looking at the data we've got for the Valley, I've got from 2005 to 2009, and then 2007 to 2012. So I've got the kind of depths of the recession included in both of the data sets. So what I really get out of this is a comparison of the 3 years prior to the Great Recession and the 3 years post the Great Recession, muddied up by having the recession in there, and it kind of muddies both of the data. The good thing about this is I think if there's a trend going on in the data, the numbers that show up in these 5-year averages will in some sense underestimate what's actually going on in the Valley. So, take it with a lot of salt and another cup of coffee, because after all, it is breakfast. The data's got problems, but the data's what we've got to use, so we're going to use it. First off, in terms of looking at the data, one of the things that's happening is the Valley's not growing. Well, it's growing, it's just not growing very fast. And it used to be we would outgrow the nation. This was a mecca. People would come here. The Valley's a great place to live. I've lived here for 40 years now. I can't think of anywhere I'd rather go. In fact, my wife and I talk about retirement, and we can't think of where we would retire other than the home we've got in the Valley. But if you look at the national growth rates, and this is the average growth rate for what looks like a 3-year period, but it's really a comparison of the average growth rate for the 3 years prior to the Great Recession and the 3 years post the Great Recession. The U.S. is growing at a 0.9% rate. California is doing a little better than that. People are still coming to California, but they must be going north because they don't seem to be coming south. In terms of LA, LA is growing at a much slower rate, and the Valley itself is growing at less than half of the rate of the nation. And until we start seeing that population growth, we aren't going to really see any boost in the housing market. So, one of the problems that's going on in the Valley, and come back 2 years from now and I'll tell you what's going on today. But from the numbers we have, growth in the Valley is relatively slow. There's been some changes in terms of where employment is taking place. What I did was I looked at the American Community Survey and where the individuals that live in the Valley are employed. There's about 10 different categories, but I pulled out the ones where there are significant changes. So again, this shows prior to the recession and post the recession. And as to be expected, the construction industry has taken a big hit. If you look at the San Fernando Valley number, which is on the far right from your perspective, we've dropped at a almost 6% per year rate over the 3-year differences there. So construction has been, I'd say, it's probably not a nice word, but it's been in the toilet. And hopefully it's going to come out because we've fallen so far, it's about time. And I'm seeing more activity in the Valley. I just don't have numbers to represent what that activity is. Manufacturing, we've all talked about hot pockets leaving and all that kind of good stuff. Manufacturing is leaving the Valley. And it seems to be leaving the Valley at a slightly faster rate than the downturn in manufacturing nationally. Real estate, we were probably the center of the subprime market. We had Washington Mutual here, which was huge in subprime lending. We had Countrywide here, which was huge in subprime lending. So we took a big hit in terms of the real estate finance market during the Great Recession. So we're off probably about double what it was nationally. So we've had a decline there. they're starting to show some semblance of recovery. If you look at kind of the Woodland Hills financial area, there seems to be a lot of activity starting up there. But again, I don't have the numbers. One of the good things that you can expect from a recession is the public sector is going to grow. And wonder of wonders, the public sector, at least in the Valley, is growing at a much faster rate than the nation. So while we talk about cutting back on the government and we don't have the taxes to pay for this stuff, for some reason they find the resources to buy people and grow the public sector. So we're observing that taking place. I want to move on and do something that's probably real suspect, and actually do a local area forecast. This is the start of an academic research paper I'm working on. Right now it's facetiously titled Local Forecasting in the Absence of Data. And I think there's a market for that out there because the Valley has no data. So I've been working on it. We don't have any real hard time data. I've got 2-year-old data with a 5-year average. I've got numbers for LA City, LA County, but that really doesn't separate out the Valley. I get the Valley separated out with a 2-year lag. But one of the nice things about the market is there's a stock market out there. And the stock market gives you real-time data on a daily basis. So you can go out and find out what is the price of Disney stock today. And instead of worrying about people analyzing and investigating and gathering the data to determine what the price of the stock is, you've got millions of people out there watching the stock market, buying and selling daily, betting their wealth on the stocks that they buy. If you bet your wealth on buying stocks, I kind of trust the numbers you come up with. So the stock market gives us a real good reflection of what people think is going on within the companies. So I've got publicly traded companies. And the assumption that's made in this forthcoming article is that the large publicly traded companies in a local area really serve as drivers for economic activity in that area. In some sense, they're a lead indicator. Now we know that the large companies here don't do all their business in the Valley. They do their business elsewhere, but they're headquartered here. So a good share of their activity takes place within the Valley. They do stuff here that causes their employees to do other things in the Valley. So in some sense, the basic assumption is they're drivers for economic activity. And it's a number I can get. I'd really love to have the kind of large private companies and the data for them, but I don't trust them. I mean, I don't have people betting their wealth on buying and selling the companies. I need to have companies that are bought and sold, and companies are bought and sold on the stock market on a day-by-day basis. Now, the base rate for comparison, in terms of comparing what I think is going on with Valley companies relative to the rest of the U.S., is essentially it's a Delphi forecast. What the Federal Reserve Bank of Philadelphia does, at Delphi you go to the Oracle and the Oracle tells you things, and then you come back and say, this is what they told us. What the Federal Reserve Bank of Philadelphia does is they go to 30 to 40 leading economic forecasters for the nation. These are the oracles. And the oracles come out with a number, and they put these numbers together and come out with a median. So the median forecast from these leading economic forecasters is that the U.S. is going to grow in real terms, that's adjusted for inflation, over the next year at about 3.1%. And this is, I think, relatively consistent with what my predecessors said and where they think it's going. Maybe a little more optimistic, but I've got 40 people out there that do this for a living. I don't have a better source. So we've got this 3.1% as a base. And what we did was we gathered together a stock portfolio. Now there are 618 California stocks that are in this portfolio. I simply used this because my colleagues in the finance department at Cal State Northridge had already created this portfolio, so I didn't have to go out and find the 618 stocks and put them together. I'm more than willing to let other people do my work for me, and they were happy to do that work. So I've got a 618 stocks. We then took the largest 18 publicly traded stocks in Los Angeles County. So there is some overlap. For example, Public Storage is one of them. Public Storage is in the Valley. It's also in LA County. Disney's in there, so there's some overlap, but it's not complete. And then we looked at the 22 largest publicly traded stocks in the San Fernando Valley. Now, we use these stocks to forecast relative stock portfolio growth. And what I used is MacroRisk, macrorisk.com. I used that because my colleagues developed it and they let me use the program. I also used the program because I really liked the underlying econometric model. The individuals that did this were trained in the same econometrics I was trained in, so I understand what they're doing, what their model comes up with, so I'm comfortable with what their forecast is. And if you want to find out more about them, I have, by the way, as a disclaimer, I have no interest in this organization other than they let me use the numbers, let me use the portfolio. What this portfolio does is it takes 18 key economic variables. So if you sat back and said, you know, who are the usual suspects in driving the economy, and listed 30 of them, you'd have probably gotten in that list the 18 that they have. It's the standard culprits, interest rates, the rate of change in the consumer price index, what's happening to money supply too. I think there's a gold price in there, there's the euro, there's an Asian stock market in there. So it's a very broad forecasting set. And then it goes back 3 years of this data, creates the best fit model to predict the current price of the stock given 3-year-old data over the prior 3 years. And then from that, forecasts what the performance is going to be relative to the economy, which is why I need this 3.1% rate from the Philadelphia Fed to say where the stock market is going for these 3 portfolios out there. So in terms of projection, these are the numbers that are forecast. LA County is going to do about the same as the U.S. There's no really significant difference between the types of stocks that are housed in the Los Angeles County than there are relative to the U.S. as a whole. So LA is going to do about the same. California is going to do worse. We don't look for, and although Jeffrey can say, yeah, California is going to do better. You know, what we look at in terms of the stock market, it's not going to do as well. Given the diversity of the portfolio, California is going to grow, but it's not going to grow at the same rate as the nation's going to grow. You know, and probably a lot of that is explained by the drought. So captured in here are weather types of conditions. So the drought is going to take a significant toll on what's going on in California. There still should be some growth, but not nearly what's going on for the nation. But what I found really exciting is the portfolio of Valley stocks should outgrow stocks as a nation as a whole. We forecast that the Valley is going to grow between 4 and 4.5%, and this is real. So about half again the rate of growth for the U.S. as a whole. Now in terms of kind of a background explanation for that, certainly in the Valley a large share of the stocks are entertainment. And the nice thing about entertainment is it's heavily finance oriented. And the low interest rates tend to drive the ability for the entertainment industry to produce. So we've got the low interest rates. We also have in the Valley a number of construction companies that are publicly traded, and construction is poised for a comeback. You know, it's been in the depths of depression and recession for so long, it's coming back. And if you drive around the Valley, you'll see a lot more construction taking place now than was taking place 2 to 3 years ago. And we also have in the publicly traded stocks for the Valley a number of healthcare organizations. And while I'm not, but you are getting older faster. And since you are getting older, you're going to have more problems and you're going to use more and more health services. So despite the difficulties in Washington with what is the Health Care Act going to do, how is it going to be funded, what's the insurance going to take place, we're still going to need the hospitalization and health services. So the Valley has, while it's a very diversified portfolio, it is a little heavy in areas that are poised for growth. And I expect that to be driving the U.S. economy, or driving the Valley economy at a much faster rate than the U.S. economy as a whole. So in terms of a summary, I have to get you out of here in time for the next session. The housing market's sluggish. It's going to remain sluggish until we get population growth. Even if unemployment goes down, it's going to go with a lag. Because if you get a new job, you're going to want to keep that job for a while and make sure I've really got this income coming in before you jump into the housing market and make that long-term commitment. Housing prices are gradually rising. I expect them to continue to gradually rise over the next year. Construction took a big hit. much more so in the Valley than elsewhere, but I think that's poised for a fairly significant comeback. So I expect 2 years from now to tell you construction was back big time in the Valley over 2014, 2015. The public sector is growing, and it will probably continue to grow because why not? We collect the tax dollars, we might as well spend them somewhere, and I just as soon spend them on me than spend them on somebody else, and that's what the public sector does. And I think the positive thing from this is the Valley's doing well and is going to do better than it's been doing for a long time. Thank you very much.
Thank you so much, Bill. Let's give him another round of applause. And if we can thank Gary, Jeff, and Bill again. I know I took lots of notes away, and I know it's going to be something that I'm going to be sharing with others as well. So a lot of learnings and insights. So another huge round of applause for all three of our panelists. And I have the privilege of introducing Rob Gonzalez, our Vice President of Advancement at CSUN, our breakfast sponsor. So Rob, if I could welcome you to the stage. Thank you for being here.
Well, we've applauded our panelists, but I think Marla deserves a round of applause as well for moderating the panel. Well, CSUN's very pleased to be a sponsor of this occasion, and VICA in general. Like VICA and like you, CSUN is dedicated to uplifting the people of the San Fernando Valley and our region. With over 40,000 students and over 6,000 employees, we take seriously our leadership responsibility in elevating the San Fernando Valley and Los Angeles and being a contributor to the vibrancy of the economic health and the culture and society around us. You'll be pleased to know that since CSUN is your university, that Money Magazine recently named us as one of the 10 best buys in higher education in the nation, and our film school was recently named one of the top 25 film schools in the country and the top in the CSU. So go Matadors. I know there's a few of you in the room. Please take time to stop by the booth outside where our St. College of Extended Learning has some materials. They are the innovators of education in the area and partner with many of the organizations in the room to provide interesting and new and tailored educational programs to uplift your organizations. Let me also give a hearty thank you to those who took time out of their busy schedules to speak at the conference, and also to the many sponsors who are here with us this morning. Let's make sure we give them a big round of applause as well. A couple of housekeeping items. To fully benefit from the activities today, make sure you take time to visit all of the exhibitors out in the hallway and to fill out your bingo card. If you complete your bingo card, you'll have a chance to win tickets, two free round-trip tickets on Southwest Airlines, round-trip tickets from Seaport Airlines, 2 tickets to What the Butler Saw at the Mark Tapper Theater, a $50 Stonefire gift card, or a $50 gift card to Amazon. Now, as you make your way from exhibit booth to exhibit booth and you fill out your bingo cards, I'm told you'll be disqualified if there's any elbowing or tripping or shin kicking, so please be gentle with each other. For the less aggressive, there's also a raffle just for showing up. You can win a Kaiser Permanente Thrive bicycle or other great prizes. So please check in with the registration booth if you haven't done so already. You can also have additional entries in the raffle if you tag or hashtag the event on Facebook or Twitter. The BFC 2014, BFC 2014 is the tag, or if you tag VICA in a post at VICA SF Valley, that's VICA SF Valley, on either Twitter or Facebook, you can have extra entries in the raffle. For those of you who know how to do that, you get a step ahead. For those of you who don't, this might be your moment to give your first tweet. So good luck with that. Also, at your seat, there's a little green piece of paper. That's a survey of this morning's event. Please take time to fill that out. Your important input helps make this the great event that it is and helps VICA improve it each and every year. Thank you for being here. Let's give our sponsors and our panelists and Marla one more round of applause. Have a great day.